All right, hi everybody. We are going to begin our last panel. If everyone can grab their drink and grab a seat, that'd be great. Our last panel of the day is technically titled Weathering the Storm, Restructuring Workouts and Distressed M&A, which is kind of a not so fun topic to end our day with. But I think it's an important topic that's facing this industry. And we've heard bits in all these other panels previously about people's concerns with where this industry is going. But I think all of us are distressed workout veterans in some capacity or another. And I think for all of us, where we see distress, we also see opportunities. And I think that's the sort of message we should keep in mind. So before jumping into the actual presentation, I'm going to ask each of the panelists to just introduce themselves and give a little blurb of who they are and what their companies do.
This direction?
Why don't you start with
All right. Is my microphone working? Yep. Sounds like it. So my name is Richard Ormond. I am a refugee from the practice of law. I am a professor. Somebody's raising their arm over there. Yes, right? 23 years. Long time. I specialized in alternatives to bankruptcy. I'm currently the president of the California Receivers Forum. I teach cannabis business law and corporate governance at Loyola Law School in Los Angeles. And I am an advisor with PGP Capital, which, talking about distress and opportunity, I'll show why those two things come together when you have a capital advisor along with a distressed expert.
Good afternoon. My name is Jacques Santucci. I'm the president of Opus Consulting. We're a business performance consulting firm. We specialize in financial modeling, strategy, and turnarounds of companies. Been involved in the cannabis industry for 12 years, starting as an operator, raising funds and starting a company 12 years ago, as a partner, as an advisor, and now we spend a lot of time helping our clients. And now, a little bit like you, two worlds are coming back together. I'm the receiver of a company here in Massachusetts, the first receivership in Massachusetts. So turnarounds and cannabis coming together.
Hi, I'm Tiffany Liff. I'm with Entourage Effect Capital. We are a venture capital fund in the space. I've been around since 2014, currently investing our third fund. I manage most of the portfolio of our fund 2 and 3 for the fund. Came out of the distressed, bankrupt, private equity turnaround space for a majority of my career. Little did I know I'd be deploying that at this point in the cannabis space, but here we are. So,
good afternoon, everyone. Kyle Judge from Hub International. I am our lead cannabis D&O expert and handle most of the placements for North America, specifically in the U.S.
Good afternoon. Thank you all for coming when there's an open bar. I appreciate it. My name is David Bunzel. I am a managing director with Young America Capital. We are a 70-person investment bank located in Mamaroneck, New York. We operate in multiple verticals. Cannabis is probably our largest, at least last year. I run M&A for the firm, and we have a 12-person cannabis team full-time. We've executed probably 35 various transactions of differing sizes. I specialize in M&A, but we also do equity raises, debt raises. We've done multiple transactions in Florida, Pennsylvania, New York, and just about every state where there is medical or recreational cannabis. The last couple of years, I've been speaking on panels about MSOs and building large footprints, and now I'm speaking on a restructuring panel, so it's kind of a sign of the times, I think, but we're also involved in restructurings and workouts for the industry to the extent that we can be.
Great. So earlier panel, one of the panelists, actually almost every of the panel we've been talking about sort of distress in the industry, but one of the panelists made a comment that he thought that maybe 80% of businesses today would either have to transform or go out of business in the cannabis industry, which seemed a little severe to me. So, throwing it out to the panel, I mean, is our industry that much in distress? And if it is, what are the causes? I mean, I know that's easy. I mean, it's a hard.
I'm sitting right next to
okay,
you. I'll
go
start,
ahead.
but I actually think that the answer is yes. This industry is a mess. And if you show me a cannabis company, I'll show you a company that is either insolvent or quasi-insolvent. Right now, because of the tax burden, the licensing fees, the legal fees, the real estate component, state taxes, local taxes, and everything else, you could see 70 to 80% of your gross revenue going to just pay those costs that I just mentioned without paying any rent, employees, furniture, fixtures, equipment, et cetera. On top of that, you now have a business that is competing against an illicit market that are not paying a lot of those fees. So you have you're really behind the 8 ball if you're a legitimate cannabis business. And then finally, the only way to stay afloat is to bring in outside capital. And how do you do that? You do that either through debt financing or new capital raises or whatever. So now you're beholden to a lot of other folks that know that you're beholden to them. And of course, they're dialing up those interest rates and dialing up the returns and the warrants and everything else. And so you're seeing a lot of businesses that are just crippling or crumbling under these crippling requirements that they have to meet.
Does anyone agree or disagree or?
I'm not as pessimistic as
we need to have some
colleague
optimism in this panel.
I'm not an optimist either. I'm a banker, so you know we play both sides. But I think to some extent he's correct. It's hard to pick one particular reason why, whether it's descheduling or being scheduled or cost of capital or any of these things. I think 80% is too high. There are certain markets, especially on the East Coast where we specialize, where companies are doing well, they're generating positive EBITDA, and they're running good businesses, they're well-financed. Companies certainly in California and other much more distressed markets, we've done some work in Oklahoma. It's very difficult to find companies that are solvent, but they exist. So I think from here, it's a lot better to be optimistic for the long run, but there is no magic bullet to solve any of those issues. Each one of those things, descheduling, 280E, getting every state rec, a lot of these things all have to happen over time, and I think it's going to take a while.
So, although I would agree with everything we said, and we've seen a lot of cases of on the past 12 years, I would call that challenges. And I think what I've seen is a lot of people did not take seriously things that we could see 5 or 6 years ago. I've been a big advocate about the cost of goods, and a lot of companies are not even tracking their cost of goods. None of them can even say how much it costs them to grow a gram. I was in Michigan 3 weeks ago. The CEO is a CPA. I was expecting him to tell me exactly how he's doing his calculation, and he's telling me he's using QuickBooks and he's taking a big number divided by a number of grams. I'm like, you have no idea what you're doing. and that's been the case for 5 years, and that's a recipe to go in the war. So those are challenges. I'm glad to hear that a lot of people or a lot of companies are now taking those seriously, the cost, working on the banking, working on employee retention, on getting the capital, reducing the cost of the debt. But we're going to get out of it. And I don't think it's all companies. I've seen companies that are actually doing okay. They're just waiting for their time to shine.
Yeah. I think it's a lot of geography based, like
That
you were
too.
talking about. The California market's a disaster. I agree with you. 80% of the companies there probably will not be around. It's difficult to compete with the illicit market. It's difficult to compete with the taxation and the regulations there. I don't know any company making money in California.
It's sad because California has so much potential
Correct.
and generates so much cannabis, but they can't get their act together.
Yeah,
Well, but I
agree.
mean, isn't part of that, I mean, I know we keep saying the illicit market, right? But how big of a drain is it upon, earnings, revenue, et cetera, in California?
So the LA Times.
You're from California,
So,
so-
the LA Times just did this whole expose on the California cannabis market, and I think one of the numbers in there was 80% of the cannabis grown in California is grown illegally. So that means that all the cannabis that's grown there, 80% of it is going to the illicit market. Whether that's out of state or in state depends. But Nevada, I have clients in Nevada that are suffering right now because of the California illicit market, and I have clients that are in Utah that are suffering because of the California illicit market. So it's a big cancer that's going on right now.
But in other industries, there are, like retail, like counterfeit, bags and other, brand name goods. So it's not as if that's technically totally unique to cannabis.
Yeah, but you don't have 280E in retail. You don't have high cost of licensing. You don't have a barrier to entry.
You have more
like you do.
enforcement. I think the
Yeah.
thing
Yeah,
is you
more
have a lot
enforcement.
more enforcement.
That's true.
Try to get some, Louis Vuitton bags, in the arbor here. You'll get caught very quickly.
That's right. That's right.
Where you can grow, start growing in the backyard a lot of cannabis, and you're probably going to get away with it.
I went to
And
a
you can
government
always tell a
conference.
difference in a
Yes, true.
fake
Can
and a
you
real
now?
bag. Yes. You cannot always tell,
Yeah.
your weed grown here and here is kind of the same, it's doing the same thing for you.
I went to
so.
a government conference in Sacramento just last week, and the biggest complaint from all the different regulators from all the different counties and cities in the state was that no money that they're collecting through their taxes is going to on the enforcement side.
Right.
It's all being used for other stuff.
Well, that's an interesting sort of segue. I mean, how much of distress is caused by overregulation? And let's just put aside, like, if prohibition ends and the FDA comes in and we have all this other sort of regulated. But, I mean, this is a highly regulated industry. And, I have heard clients of mine waiting months they've grown their cannabis and they're waiting. So how much of this is a byproduct of the regulatory framework that's sort of, no offense to regulators in the audience, but it's an industry that needs to grow, but from my operator clients, all I hear is, well, the regulations are just as much of an impediment. I'm just wondering what people see or think.
Alcohol is highly regulated, but we can grab a beer right now out in the hallway and without much trouble. But for you to buy weed in California, you have to go through a number of hoops just as a consumer. And as a retailer or grower, or a distributor, you're going to have incredible amount of regulatory issues. So I think it's 50% of the battle.
Well, you see it also in the new markets like New York, where everybody's been waiting for 2 years. New York's going to be a huge market, and people are waiting, and inevitably, people are going to start or continue to grow illegally or import it from other states. So I think there's a part of the regulations or the lack or the delay in the regulation that's forcing the illegal market.
But is that all? I mean, what about the fact that we were talking about this earlier, if you're an MSO, right, you can't necessarily have one packaging fits all
Yes.
your products across multiple states. And what can you do about it?
Not much right now.
No, not much. That's why, anybody's looking for federal legalization is probably not understanding what they're asking for, because that would be a catastrophe. I don't think the industry is ready for this, and I think we need to push more for safe banking, less 280E, better enforcement of regulations to reduce the black market, and then the company is going to be able to compete and work on those challenges that are turning some of them cash flow negative.
Do you know that
And
most states are not in favor of federal regulation because they're afraid they're going to lose the tax base that they're
Right.
developing also.
Right.
So they don't even want the federal government to legalize this because Ohio is going to start selling California weed the minute that interstate commerce
yeah,
is
for
allowed
sure.
to have.
There's no one magic bullet, right? I mean, generically speaking, it is due to regulation, but it's going to be a long time before all of that is solved. So it's definitely a cause, and there's no real one solution. Everybody's banking on descheduling and legalization, but that alone is not going to solve the issues that we're seeing.
Yeah, they're going to have to, New York's going to have a real problem because they've waited so long to get into the game. You can buy any branded California product in any store in New York, anywhere now. I mean, you can walk into legal stores in New York and buy California branded products. So they're being sold to burner distros in California and then shipped across the country. So New York is already experiencing an illicit market problem, and it hasn't even started legal sales yet.
Yeah.
So until that piece is solved, I think you're going to consistently have a problem.
But what's interesting to me, listening to all of you just now, we kept talking about, I would say, external factors, 280E, illicit market, regulatory, inflation, whatever. But what about, I guess I'll call it internal, like the actual, like what you were talking about, Jacques, about actual even knowing what your costs are. I mean, how much is that a problem that you're seeing? And like, for instance, David, you get hired all the time. I mean, you must see, I don't want to say horror stories, but you must see, companies that, like Jacques said, don't know how much it costs them to produce a pound of weed.
A previous panelist was talking about management, and I think cannabis is no different than a lot of other industries, maybe slightly worse, but who knows? You know, it's all about your management team and betting on good managements. And the good management teams, they do exist in cannabis, know all that stuff. And there's quite a few that don't have the internal controls, that don't have a handle on what's going on in the business. So that's really what it comes down to.
I would say also that you have a group of people that were in the industry for a very long time that developed very bad habits because of the quasi-illegality. And so we would jokingly call it from going from backpacks to briefcases. A lot of people haven't made that transition, or they stumble while they're making that transition, because it's very hard for them to get out of these old habits that they've developed about hiding cash and everything else that they've been doing. And that leads to a number of problems, especially when you have outside investors that want to get reports and look at the data and analysis and everything else, just like you're talking about, and it doesn't line up to the way they're used to looking at things.
Yeah. I would say that's one of the optimistic points in the space to me, is that we have seen in our fund and with the companies we're looking at a real professionalization over the last 2 years, 2 to 3. So since 2019, I feel like the management teams have really brought in real professionalized people from outside the cannabis space, not kind of your OG that you're speaking of, the backpacks or the briefcases. I mean, that's a hard jump for some of these original founders, and they have great brands and they've created spectacular brands, but they've had to bring in real management teams at this point, and we have seen that transition. So that is a positive in the space.
Well, we also talked, or people talked earlier about the branding and matching the product with the consumer. Well, it's only been a couple of years where you see really products that are matching what the consumers are looking for. I think there was probably an overestimation of what the consumer was looking for and how much they were willing to pay. So the original consumer, sure, they'll take whatever weed you sell them. But the new consumers, because to go from wherever we are to double it in the next 5 years, you have new consumers. You have to find those products. And I don't think the management of those companies were ready, or maybe they didn't want to invest in those.
But also there was a lack of data. I mean, like every other consumer product goods industry, you have a lot of data to support consumer behavior. Is it as simple as, well, now that we're in the 4th or 5th inning, whatever inning we are, we'll have better analytics? Or is that just too
I would
simplistic?
agree. I would agree, but there's a few companies that we're starting to see, they've been producing cannabis in whatever forms, flower or extract, a lot more than the past 6 months of sales, because they were expecting, a hockey stick. Well, I think at some point you got to realize that if you haven't sold in for the past 6 months, it's probably not going to happen in the next 6 months, knowing that you have more stores opening around where you are. I mean, we've seen it in Massachusetts, right? A year ago, everybody was super bullish, 4,000 a pound. Well, a year later, it's 2,000 a pound.
By the way, that for California,
it's good. I know it's good. It's good.
I'm like, I'll take 2,000 a pound any day, right? Yeah.
Well, maybe you have to track it here.
Yeah, right.
So Kyle, I want to bring you in. Yeah. So Kyle, you're a D&O in cannabis, D&O expert. And oftentimes in workout situations, insolvency situations, the only meaningful asset for certainly unsecured creditors could ultimately be the D&O policy. In fact, I know, Jacques, we're working on that first receiver in Massachusetts, and there's a D&O claim, although there's no D&O, but that's a different story entirely. As companies are facing the hard realities that, regardless if they're insolvent, there's some distress. I mean, can you talk about, your world in terms of D&O? Like, what should, if I think I might have some distress coming up, what are certain things that I should be doing looking at my D&O policy, especially if I'm a director and officer?
Yeah, that's a great question. And I think the first thing is take a look at your policy, because if you're what I would call on one of the legacy carriers, something that's been written in the last year or longer, it's a very large reality that you probably have some form of insolvency exclusion on there, or sometimes they'll throw on a bankruptcy exclusion where it's not truly bankruptcy. It's got such broad wording on there that it could really become a problem in the case of an insolvency situation. So from a directors and officers standpoint, I think if I was a director or an officer, I'd want to make sure that the D&O policy is going to react in case of those side A claims when there's no indemnification coming from your organization. So that would be the first thing I would do these days. The market has softened up a lot, that assuming that you're not insolvent or looking like it's going to be an issue in the next 6 months, you can tend to get those exclusions reduced or removed from the policy entirely.
Can you explain a little bit more, because I think this is really important, what the insolvency exclusion is and what practically the result could be? Because I think you and I discussed this earlier, and it's really important, I think.
Yeah, so I think the largest issue there is that these exclusions tend to have what we call in the industry an absolute language on there. So it's based upon arising out of or any way related to XYZ, an insolvency situation, however it might be spelled out within the policy. But the problem is a lot of these shareholder suits, creditor lender suits can be arising out of that or based upon it, right? If your company's going insolvent, almost any allegation brought against the board is going to be arising out of that insolvency situation. So the problem with how broadly these exclusions are worded is that it could effectively nullify your D&O policy, and you won't have any coverage there, which as a director and officer is obviously a serious issue.
Well, yes, because then your personal assets potentially are up for grabs. But it seems to me then, what folks should do, even if they aren't concerned with insolvencies, maybe have their broker or contact Hub, and I'll do the commercial because I think this is really, really important, to look at their D&O policy. The rates have come down, and whereas like 3 or 4 years ago, you could barely get a policy with a reputable agency.
I would say 6 months ago, you
Well,
were
6
you
months
were
ago,
paying
there
an
you
arm
go.
and a leg, and we've seen such an influx of competition that it has driven rates down. Now, it's still expensive compared to non-cannabis clients, but we are seeing such a competitive rate environment compared to recent years. And to your point, I would say take a look at your policy before you get in a situation where there's insolvency, because that's when you're going to be able to convince an underwriter to remove those exclusions or lessen the how broadly they're written on the policy.
Because your underwriters will have to look at the overall financials of the company, right?
I mean, they're always going to take a look at, what does the current financials look like? They're going to look at a projection for the next 12 to 18 months. So the best time to do it, to be honest, is now, or if you're renewing in the next 3 to 4 months, because the market, like I said, has softened a lot, that you're able to drive some better results out there currently.
So if one of our lenders in the audience is giving an operator a loan, it's probably a good time then, because conceivably it's been underwritten by the lender, so you're in decent enough shape for your underwriters.
Exactly, yeah.
So besides checking go
Can I
ahead.
add something on
Please.
insurance? So I'm not an insurance expert, but as we're talking about distressed, I think also a coverage that's important is EPLI, because some of the issue or the challenges can come from the employee side, and because we're dealing with new companies and new type of management, I think that's a coverage that's very important because that can get you out of trouble, and those trouble usually can create cash issues.
Right.
Yeah, and I've certainly seen an uptick in that request. 2 years ago, I couldn't get any of my clients to even think about employment practices insurance, and nowadays it's much more common for them to be buying the directors and officers employment practices. And the good thing too is the market has, I think we touched on it, David and Tiffany touched on it, is that the C-suite and executive teams are starting to become more advanced, sophisticated, reputable. And the insurance carriers are starting to catch on to that. They like that it is getting, I think we said bags to briefcase. And that is, I think, really driving significantly better results in the employment practices market. So I think that's a very good point that a lot of our clients are seeing.
Because in distress, people get riffed.
Right.
And if
layoffs.
they get riffed, there's wrongful termination action.
Exactly.
So besides insurance, so all of you, this is important. What can or should folks do right now in terms of looking at their organizations to avoid sort of the more drastic sort of remedies or situations we're going to talk about in the second half of this hour? Obviously we can't change 280E. We can lobby, but they ain't going away, and it may be even worse with the MORE Act that Schumer wants to bring.
I'm going to take Jacques' line and say disciplined practice in how you do your accounting, your record keeping, and everything else. Just that little tweak is going to make a significant difference in how you can approach an insolvent situation.
Disclosure, we only met 2 weeks ago. I did not pay him to say that. Yes, I would agree. Diligence, be realistic with the numbers, and put the tools in place. You know, it's not about growing weed, it's growing a business. And just the cannabis part is just the product.
So it's, oh, sorry, go ahead, Tiffany.
No, I was just, I mean, this is a long game, right? Everybody got into this in like 2017, 18, thinking it was a short game. They were going to make money very quickly and get out, and that has not come to fruition, right? So it's more of a long game, and during that time period, everybody was rewarded with just revenue grabbing, right? So you were multiples of revenue is what your company valuation was based on, and nothing to do. Nobody talked about EBITDA. Nobody talked about, you know, positive gross profit margins. Some people were selling, like you said, negative gross profit margins. They didn't even know it.
Yep.
And so it's also a collectability issue. So revenue at all cost is a bad idea just for multiple reasons. But right now there's a collection issue in the space. So you can sell all you want, but if you can't collect, what are you selling for? So it's very difficult for a CEO and a company to take, you know, your top line revenue down, because historically you've been punished for that, especially in this space. But to take your top line revenue down and have profitable gross margin business and collectible business is the key right now. And I think that's a tough call for a lot of people.
But is it just revenue? I mean, you know, a lot of startups, right? Let's look at the high-tech startup world. You know, they burn money and they do not generate profits for years at some point, but they have access to the markets, the capital markets. They can go out and raise money and go on NASDAQ or whatever. You know, it seemed like what you were saying, like 2018 or 19, everyone was going public and raising zillions of dollars, and, you know, half the companies had market caps greater than, you know, Levi's, or, you know, there was an example I remember reading. I mean, is any of that related to the drop in the capital markets we've seen, or is that just an easy excuse? Maybe there's a time to stop spending like you spent 2 years ago, essentially.
Yeah, I think people like to compare cannabis to tech, but it's really not even equivalent at all. I mean, tech is people, right? So if you have a riff, you're cutting people, you're cutting your burn. Cannabis is a traditional sector space. I mean, you have agriculture, you have distribution, you have manufacturing, and you have retail.
Yep.
I mean, those cost a lot of money to do all of those things, and most people have to be vertically integrated. I mean, it's very difficult to find a management team that's an expert in all four of those categories. I mean, no other sector in this country, you know, so many verticals,
yeah.
Right? Everybody is, you know, you have a distributor, then you have a retailer, and then you have a manufacturer. So it's, you know,
But what's interesting, I mean, I keep, and I'll let you jump in, but I keep hearing different thoughts. Like, some people are like, I have to be vertically integrated. Some people are like, yeah, I'd rather just do retail because I do it well. And I know it may depend on the state, but like, what do you guys think about? Is it better to be vertically integrated?
I think it depends on whoever it is and where they want to take the risk. I mean, you know, some non-cannabis companies that we know, they only retail and they do very good, and some of them, they decide to have all the distribution. Depends on your appetite, that depends on your management team.
I personally think this is a commodity.
Yes.
And it's a commodity like any other commodity, and I think that you have to start looking at other commodity businesses and see what works in those industries and then translate it over to our industry. I think one of the differences, though, is that for the most part, you know, you have MSOs and everything else, but for the most part, you're stuck within the four corners of your state, and so you're still making decisions on a commodity that should be traded nationwide based on state-by-state regulations. So I think that you're at a certain disadvantage in that regard. And that's why I think it's such a strange kind of hybrid industry right now, because it doesn't follow the same exact rules that a commodity should follow.
Can I come back to what you said
Yes,
on
please.
tech? So when we raised money for our software related to cannabis, the metrics people were asking me were always the same. You know, cost acquisition and things like this. But the definition is clear. You know what you're talking about. Then you go to cannabis, and depending on the state, a canopy is not the same definition. And then one company is not talking exactly about the same thing. And so I think it also put another spin. You know, it's not really like tech. The industry needs a little bit more standards, so then we can compare one and the other, and then you know what you're dealing with. And I think the answer to vertical versus retail is going to become clearer, because then now you have metrics, that qualifies each of those verticals.
So it's analytics to a certain extent. So David, let me turn to you and talk about the M&A market, or potentially lack thereof right now. And I know I want to talk to you just generally about what you are seeing, but late last week, Verano announced and went on the wires, I think last night, that they were terminating their agreement to acquire Goodness Growth for like $400 million or something like that. And now they're suing each other. So yes, more money for lawyers, yay. But is this something we're gonna, I'm assuming, in what one of the press releases I saw said, that Verano said, well, we tried to renegotiate the price down because it was just too high and they wouldn't, so we exercised the right to terminate. And hopefully you weren't involved in this. I'm not asking you anything. I'm not supposed. But is this a trend that we're going to see with respect to deals that are out there that may have been signed but not closed due to regulatory whatever?
For sure. Not the only large deal that's collapsed in the last couple weeks and months. MedMen New York fell apart.
Right.
Before that. And in both cases, the press releases were blame the market and blame deterioration in core businesses, but they've been deteriorating for a while now. It's not new news. I think that the acquirers in both cases had issues with their own equity and their own balance sheets, and they were just doing what they need to do, which is their fiduciary responsibility, because they see the handwriting on the wall for this valley that we're going through. And I think it's always been here. In a bull market, it was very easy to pivot and get a deal done away. But right now, it's definitely going to affect M&A, and it's a reality.
So what are you seeing, in terms of multiples or deal structure, the differences between, let's say, now, last couple of months, and even like 6-9 months ago to a year? Because from our experience, it's totally different world.
It's definitely a different world. There are pockets of cash around, but I would say cash is being husbanded like nobody's business. Deals are much more equity heavy and much more stock heavy, much more, a lot of reps and warranties in there for certain things that people are buying. And I would say there's very little cash available, at least from the pubcos, to do deals. The financing markets on the debt side have kind of opened up a little bit, but then with the backup in the curve, it's become a lot more expensive. So the M&A business is definitely slowing and probably more to go. But there's a rainbow on the other side. I mean, I think eventually,
Sure.
when some of these issues get solved, we'll be back to a more robust market.
But but M&A doesn't just disappear right now, right? So, there are many groups out there, not just MedMen, who are having financial difficulties and they need to sell, right? For whatever reason, whether it's a couple of licenses in the state or their entire operation. If you were hired, what would you tell a potential seller in terms of what they should do now to get a higher price, to the extent there is any money out there?
Yeah, be prepared for dilution, and do whatever you have to do to survive the next couple of years. That'd be the first thing. Stay in communication with your cap table. That's probably the most important thing, because it's likely that the solution is in your cap table, whether that's doing a rights offering or doing something that compels your current equity shareholders to help you go forward. We're closing a deal in a couple weeks, touch wood, where we only financed it from internal shareholders. We put bells and whistles in there to incentivize them, and it looks like it's going to close, and they're going to hopefully have enough runway to make it to the other side. So it's very easy to crawl into a hole when things aren't going well and not communicate. I'd say communication with your shareholder base is of utmost importance in terms of what you can do.
So sellers should wait and try to get their balance sheet in order and
if
cut
you can.
costs?
Some people can't. There's no oil left in the tank, but to the extent that you can do anything to bring capital in, take the dilution. A sell now will be definitely a depressed multiple. And if you can make it to the other side and get there, I think you'll be well rewarded.
See, I think this is where Darwinism comes into play.
Sure.
Right? If you're a good operator and you're disciplined and you're able to do the things that you said and do the things that you said, you might be able to survive. And I say might be able to survive. But I think there's going to be, I call it the grand consolidation is coming. There's going to be a grand consolidation, and not everyone's going to get to play in that game. Somebody mentioned the rule of three earlier, but it's a Massachusetts law that they were talking about. But there's the rule of three in business school too, where eventually most major industries consolidate into three major players. This industry will be no different. It'll take a decade to get there, but this industry will get there.
But it's not just Massachusetts that has concentration limits, right? I mean, Missouri has 5, Ohio has, this is for retail. I mean, we can go, and then we'll put aside the residency requirement for now. But I mean, states have created, I'll just say in my opinion, artificial barriers to consolidation.
That's right.
So how can we get to 3 or 5 or 10? Like for instance, in Massachusetts, there's 250 dispensaries, give or take, open, another 200 in queue, and we all know not all of them will survive or make it out of queue. But if you can only own 3, how do we, I mean, and all the big MSOs are here.
I think there's going to be 2 things that happen.
Okay.
One is you're going to see, and I think it's going to take 10 years, but you're going to see a gradual relaxing of federal restrictions. So you're going to go to the Fair Banking Act if it ever passes, or Safe Harbor Act, right, if it ever passes. Then you're going to go to a change of schedule. Then you're going to go to, well, it's okay for medical, but not, and so you're going to have these different transitions that the federal government's going to make over the next 10 or 15 years, I think. That'll be part of it. The other is this, is that I hear grumblings about restraint on trade issues that are going to be brought up and everything else. I think the lawyers are going to start really getting more aggressive in that regard, especially as we see the dominoes fall in the industry. So I think you're going to see a lot of things that the states are doing because the federal government is not involved is really a restraint on trade in a lot of respects, and it's going to be challenged for sure.
But so let me ask this question to the entire panel. We're not there yet, right?
No.
So let's say
this is future casting.
No, of course. But let's say you are an advisor to, or Tiffany's case, you're an investor in a group that has retail, whether vertically integrated or whatever, and they have hit rock bottom. They can't pay payroll in 2 weeks. I mean, what are the options that are available from and let's take it from the operator perspective as opposed to like a secured lender or whatever. We can deal with that later, because I know both of you have been receivers. But from you guys, you go into companies, you help turn them around. And Tiffany, you've bought distressed companies. I mean, what is interesting or what's different about cannabis versus anything else? And what can a cannabis operator do if they really can't pay the bills?
I mean, I would say historically there was so much low-hanging fruit because you did not have professionalized management teams. So coming in and taking over a company or having to restructure a company was fairly simple. There was still investors willing to invest. You give incentives to the current cap table. I mean, that's what most of the restructurings have been in the last probably year or so, is current cap table coming in and protecting their investment, rescue financing type of work within that space. The multiples have come down because the publics can't issue shares at these prices. It's too dilutive. So they're not going to take on, they're not going to pay 2.5 times revenue. They're going to pay half a turn of revenue, if that, or they're going to just take advantage of, really distressed opportunistic deals that are, people going out of business where they can just take over the assets at the end of the day. So it's a tough space, particularly in an M&A situation today and on a restructuring. I mean, you can't take advantage of bankruptcy, so you can't shed liabilities, you can't shed leases, you can't do all the traditional things. There's no 363s, where you can just buy free and clear assets out of a bankruptcy. I mean, once they deschedule and once we can access the federal bankruptcy laws, I mean, it becomes a lot easier to save companies.
But there are alternatives.
Right. There's ABCs.
There's ABCs and things like that.
Right.
They're not perfect, but at least they exist in this world.
Yeah.
But there's also a point of no return, though. If you want to actually buy these assets, once the CDTFA in California, which is the taxing entity, or any taxing entity for that, starts leaning up those assets, those assets become much less attractive because why are you going to acquire assets that are leaned up by the state? So it's almost better for those people just to walk away from that at that point. And I'm dealing with that in California all the time. The biggest creditor in most of the situations I see at this point is the CDTFA, and there's almost a race to try to get an ABC done or a receivership done or whatever it is before they start recording liens against the assets and start asserting their positions, especially if that debt table is or there's not a lot of secured lending going on in that space.
Yeah.
Right?
In an unsecured situation, I mean, the only thing you can do is literally stop paying and wait for somebody to put a claim in against you, which takes a couple years through the California system. So, nobody wants to say don't pay your bills, but if you can't and you're trying to survive, that's the only way you can do it. Because we haven't had access.
A little bit of fat in some of those companies that are actually in trouble. 280E wasn't done properly for 3-4 years. You get $500,000 that you pay too much to the IRS. 2 or 3 executives that are getting paid $250,000 to just hang out. So just right there, you can scratch and then that's not going to solve the situation. That's just going to buy you a little bit of time to put things in place to maybe resurrect the company.
You mean like CEOs driving around in armored Range Rovers? Yeah.
That never happens in startups. But it seems.
I've seen green Lamborghinis though.
Oh, that's good, yeah.
But it seems to me, I mean, and I'm just thinking like many of these operators, many of the founders, they go in, there's green rush, blah, 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 but they forget turnaround 101. So for instance, I've read about groups, shuttering doors or dispensary doors. But if you don't pay your employees, that could be personal liability. In certain states, if you don't pay sales tax, that can be personal liability.
We call it a trust tax because it's held in trust.
Well, never mind that,
Yeah,
but I'm just telling you sales tax, but if they don't pay your FICA, and I think all of us, or a good number of us, have seen that on the non-cannabis side. I mean, do you think with your experience working with groups across the board, are they even aware of this? I mean, the traditional, okay, these are things, WARN Act, all these things that we as turnaround professionals or bankruptcy folks are used to asking day one, is this sort of like this silent liability that's hanging over folks like at the D&O level who don't realize there's personal liability?
Yeah, I would think that most people in this room are aware of those things, but some operators are using the so-called lack of banking and payroll as an excuse to escape and not pay those things, and they don't realize the implication for those things. And that's not an excuse, there's payroll and banking available. The only states where I think we had a problem so far is Hawaii because of the international water between the islands, and there's not too many banks, and we did a project there. It was a little bit painful, but every state we worked in, there was a bank that was willing to work, and there was a payroll company, and there's an insurance company, and the operators, I think, sometimes are using that as an excuse to maybe make a bit more money.
And Kyle, correct me if I'm wrong, usually D&O policies will not cover liability of directors and officers for failing to make payroll, trust fund taxes, sales tax, go down the line.
Yep, yeah, that's correct.
So these are really the important things that people need to be aware of.
Exactly, yeah.
We haven't seen too many people on the, none, at least a lot of our companies or the distressed ones we've been involved in on the payroll side. Everyone's pretty diligent about making those types of payments. For the most part, it's the CDTFA that, it's been free money to California companies for them. So they don't get in trouble for a couple of years. It's free financing. Once you pay it, they'll take a payment plan. Once you pay it off, they'll get rid of the penalties. So they've created a situation. Well, first of all, it's too high and to begin with the taxation, but they've also created a situation where people have used that as free money because there hasn't been, access to capital in the space.
And there's no enforcement really until recently, now that they've started recording liens and doing things like that. But even now that they're very understaffed to begin with, so
it's a year before they even get around to you.
That's right.
So
that's exactly right.
Actually, I don't think we can make a generality. You have a good point. Not every company is like this.
Of course.
The smaller companies, closer to the black market, just they may not do everything the way they should, but then most companies that are trying to create a real business, they pay taxes, they do the payroll, they know all those things.
Yeah, but for a long time, people weren't paying taxes timely because it was arbitrage, right? Because the government gave, the penalty the government instituted was less
Some
than
are
you could.
still doing it.
Yes, some are.
Yes, yeah, they are.
See, and from my perspective, I don't really see them until they're past that point. So for me, most of the companies I see have made those mistakes and
Sure.
have not done those things. So I think you guys have a slightly different perspective from me because I jokingly say I'm the cleanup crew. I get there after they say, "Oh shit, we need to
Yeah.
turn ourselves around."
I've yet to see, I mean, the CDTFA put anyone out of business that we've worked with for lack of payment. They've worked with them, they've put payment plans in place. I haven't seen it in anything that we've done, but I'm sure it's out there.
Yeah. No, I've definitely
Yeah,
seen it.
I'm
yeah.
sure you have, yeah.
So you know, Jacques, you and Richard have both been receivers, and I think receiverships right now, with the lack of federal bankruptcy, is probably one of the stronger sort of
Cool.
insolvency proceedings with a judge that we have. You know, maybe both of you could just touch quickly on your experiences serving as receivers, because I think, you know, like, you know, the one that Jacques, you and I did, the first one in Mass, will not be the last one. And I know that the ones you've done in California will definitely not
Definitely
be the
not
last
be the
ones.
last one.
Go ahead. No, go ahead.
So
You've done more than-
California is very interesting because it has a robust receivership structure. And so they've been using receivership kind of as an alternative to bankruptcy. What we've been doing, and one of the reasons why my receivership company partnered up with PGP Capital, was because we try to pre-package these receiverships ahead of time. So if we can find a buyer for the assets or new money that wants to come in, and we can get a court order that sheds some of the liabilities or all the general unsecureds or whatever, we want to put that all together before we even go into the receivership court, because usually we're dealing with investors or with lenders, and the companies mostly cooperative. We can do these what we call pre-packed receiverships and go into court and do that. But I have situations where it's by force as well, where a lender just is fed up and they want to get you know, the people out that are operating the business, and they go in and they get a receiver, and it's a different type of animal altogether. But there are very few alternatives available to these businesses, especially taking bankruptcy out of the equation. When I was representing lenders back in 2008, 2009, it was all about not having any cannabis in their banks and not dealing with any cannabis issues, the AML issues, the BSA issues, et cetera. Now banks are actually lending to these businesses, right? And so for them, the lack of bankruptcy is something that they can't totally get their minds around sometimes. But that's
Well, that could be a good thing
Right.
or a bad thing,
Right.
depending on the situation.
That's right. So then we have what's called an ABC, which is an assignment for benefit of creditors, which is almost like a Chapter 7 bankruptcy outside of any court supervision whatsoever. What's interesting
Except in
is-
Delaware.
Except
A
in
couple
Delaware,
of
right.
states.
What's interesting is that an ABC, one of the biggest threats to an ABC is an involuntary bankruptcy, but because they can't go bankrupt, that threat goes away. So an ABC does become a little bit more attractive. The thing I've been doing lately, though, is Article 9 foreclosures. Is getting a senior secured lender to just wipe out all the security that's after them, sometimes even taking subject to the tax liens that are there.
So, but isn't that easier in California, where, you know, as long as you have, 20% of the same ownership or something, it's not necessarily a transfer. How do you, I mean, as opposed to other states, where you have to get official approval?
So California is really interesting. The licenses at the state level are non-transferable, but at the local level, you can transfer it depending on the municipality. So what we do is we go to the municipalities first, ask them to do the transfer, and then they have to reapply to the state for a new license. However, there is one exception. If the state is named as a nominal defendant in the receivership case and the court orders the transfer of the license, the state has to follow what the state court tells it to do. The BCC doesn't like that, but they'll comply.
That's interesting. And so I just know in Mass, because I've tried to do an Article 9, here you can sell or transfer a license, you have to get approval, but in order to initiate that, the license holder has to actually file the change of control, and you can't do it as the secured lender as sort of like, hi, I want to do an Article 9, and I may, you know, buy it by credit bidding my debt. And I know a lot of other states that becomes an impediment
And you
too.
have the same problem with the HCA too. You can, you know, you can't really transfer the HCA without the license holder agreeing on it.
That's right.
The advantage of the receivership that we found here in our case, is although we didn't have the bankruptcy protection, the protection that bankruptcy usually brings, it gave us a chance for 2 or 3 months to actually put everything on pause, look at what was going on, change a little bit the management, reassess the situation, and then find a solution for the estate.
The problem that I've found as an equity investor, or even when putting debt in, is that time frame in a cultivation facility is tough. So because you have a living plant, so 3 months of ignoring that and not funding it is
yes,
that's
It's the
a-
fox watching the hen house
We
situation.
Yes, we took that into account. I
Yeah,
agree.
and then what happens like for the DIP financing? Like, is somebody protected coming in on
Yeah,
that?
so in California at least, you have something called a receiver certificate, which gets a super
Do you want to
priority.
explain what DIP financing is? Because
So,
maybe
so DIP financing is debtor in possession financing, which is in bankruptcy court, where someone comes in and provides a Chapter 11 debtor with particular financing, and they get a super priority to get paid back. And then it's negotiated. There's a lot of terms you can go up and down on and everything else. In California, you have receiver certificates, and other states as well. Nevada has them. I know that Colorado has them. And we actually, in our receiverships in this industry, have tried to model them after the DIP financing in bankruptcy court, so as to give the best protections we can to those lenders. And those are court-ordered senior liens. So and you can actually take a lien against assets as well and have it jump ahead of other creditors, so long as they're members of the lawsuit. If they're not part of the lawsuit, they're not getting official notice, so they might not be subject to that superior lien. So you have to make sure you bring in all of those junior creditors into the lawsuit itself. But you can get senior financing in that fashion for these pre-packed.
So I have a question. Is that a byproduct of if you have a state court judge who understands bankruptcy? Like, is there discrepancy? Because I know in our situations here, I've been across many state court judges, and some understand debtor-creditor and some don't.
I become an educator many times when I'm in court. I have to educate judges a lot on these types of issues because this is alien to most of them. This is something that is so outside their area of expertise. Remember, most judges, in California, they do have a criminal docket and a civil docket. I don't know if in Massachusetts if it's the same, but 80% of their docket's criminal anyway. And so for them, the civil cases are already a challenge in a lot of ways, especially for their clerks. To bring in a court of equity issue, which means that they're not even following statutory law, they're following the equitable precedent that has existed for 1,000 years since the courts of chancery in England, blows their minds. And so you have to start with baby steps and educate them piece by piece by piece as to how this is going to work.
So Tiffany, I think I may have interrupted you. Were you trying to say something?
No, I was just saying, what's the priming lien on that? So I think that's a tough part of,
Right. Well,
somebody coming in.
My fees come first as receiver. Then that primes everybody. Then the
You forgot the Receivers Council.
Yeah, the Receivers
Sorry.
Council next. Yeah, sorry. You get paid too.
Thank you.
And then next would be usually that certificate provider would get paid right after that. And then it goes down for that. And then if they
So
have
taxes aren't priming then?
So taxes, it depends. So that's an it depends answer,
Yeah.
right? That's the total lawyer answer. But it depends on if they're recorded taxes versus non-recorded taxes. If they're trust taxes or sales taxes, they might fall in a different priority scheme. But
Although there are statutory liens, right?
There are
Like, so the IRS taxes become a lien by statute upon assessment, I think is the
That's
term,
right.
whatever the heck that means. So we generally take it to be April 16th
Yep.
of the following year.
do the
It becomes a lien just on a conservative basis.
Right.
That's right.
And now you see why investors don't jump in and
That's
do
right. It's not for the faint of
Do
heart,
this-
and that's
that
why
investing.
they charge a premium
Right.
for those dollars, right?
So Tiffany, maybe let's sort of end on a higher note. Right?
Pun
Yeah.
intended.
Oh yeah, no. But yes, now it is. You have been a distressed debt purchaser. You've been worked in this area for decades, as you mentioned. Taking those skill sets and that experience, that knowledge base, to cannabis, what would, if you had a distressed fund, and maybe you will have a distressed fund, entourage, but what would you be looking for in terms of opportunities for acquisition, whether it's the company itself or assets, or just sort of we can turn all of us vultures that are on this into giving some
opportunity.
optimism?
I'd be looking at debt maturities. I mean, for the most part, that's, I think, the key indicator of, when somebody's going to be in trouble is understanding what debt is out there on the books, when it's maturing, who's in that debt, and what they're going to be looking for if they can provide additional capital. I mean, a lot of people are just out of capital at the end of the day and can't put protective advances in or can't save their current investment. So in those situations, especially with the pubcos, and I don't mean the large MSOs, I mean, like the smaller pubcos that are out there, you can just do a scan of those and you can see when their debt's maturing. If you have something maturing year end and the company's losing money and they have a minimal cash on their balance sheet, and we all know the debt market right now, it's difficult and tough. So, I mean, those are kind of the opportunistic areas to me.
And David, are you having clients yet, or soon will be calling you up and saying, hi, what's out there for special situations?
I would say yes, and I think that for every distressed opportunity, there's probably at least a half a dozen people who are looking to buy distressed opportunities.
Well, that's good. That's good news, right?
Mm-hmm. Yeah, debt's definitely out there, for sure. I mean, it comes with very
Sure.
expensive warrants, and where you're going to own, especially at these valuations of these companies, and they're
Of
they're
course,
going
the
to own
question
30-40% of the company for a small,
right. I mean, the question is, will the sellers actually want to sell at the right price, or will their lenders, with liens on all the assets, allow it to be sold for less than, what they put in as a loan?
Yeah,
They're going to have no choice.
right. That's what I think too.
Agreed. All right, so we are a minute away from the bar. So let's see if there's time for one more question, or actually one question period, and then we can all hit the bar. All right, we're all going to hit the bar then. Thank you, everybody. Thank you.